Booyah! Welcome folks to the show. AI is the hottest story on Wall Street, sending stocks like Nvidia and Palantir soaring. But is this real sustainable growth or just another bubble? Remember, bubbles are driven by hype and FOMO, prices soar, then crash, and fortunes vanish. The bulls say AI is revolutionary and profits will justify the hype. The bears warn of déjà vu, recalling the dot-com crash. So, is this a golden ticket or a dangerous trap? Let's dig in. Your money's on the line. When Michael Burry talks, you listen. He's not just another Wall Street voice, he's the man who famously saw the 2008 financial crisis coming when almost no one else did. His warnings were ignored back then, but history proved him right. Now Burry is back in the spotlight, and this time, his focus isn't on subprime mortgages or housing bubbles. It's on the explosive growth of artificial intelligence and the tech giants driving it. He predicted the 2008 crash, and now he's sounding alarms on AI. The world is captivated by the promise of artificial intelligence, with headlines touting breakthroughs and investors pouring billions into the sector. But Burry sees troubling echoes of the past: irrational exuberance, unchecked optimism, and a dangerous belief that this time, things are different. He's warning that the same kind of blind faith that fueled the housing bubble is now inflating the AI boom. Burry warns of a closed loop. Giant tech companies like Microsoft and Google spend billions on AI chips from Nvidia, inflating each other's numbers in a money circle. These companies are not just customers, they're also investors and partners, creating a feedback loop, where each company's spending props up the other's financial results. It's a system that looks strong on the surface, but Burry suggests it could be masking underlying weaknesses. If one part of the loop falters, the whole structure could unravel quickly. He points to a historic spike in tech investment, a classic sign of a speculative frenzy. The stock prices of AI-related companies have soared to record highs, and investors are celebrating massive gains. But Burry cautions that such rapid growth is rarely sustainable. In the past, similar surges have ended in painful corrections, leaving latecomers with heavy losses. The excitement is palpable, but so is the risk. Everyone's rushing in, ignoring risks, until the music stops and there aren't enough chairs. It's a classic case of FOMO, fear of missing out, driving people to invest without fully understanding the dangers. Burry's metaphor of musical chairs is a stark reminder. When the party ends, not everyone will find a safe seat. The rush to get in can quickly turn into a scramble to get out. Burry also notes slowing growth in cloud computing, the backbone of AI. While cloud infrastructure has powered the AI revolution so far, recent data shows that expansion is beginning to plateau. This slowdown could signal trouble ahead, as the relentless pace of AI development depends on ever-increasing computing power and storage. If the infrastructure is slowing, how can AI profits keep skyrocketing? Burry's question cuts to the heart of the matter. Without robust growth in the underlying technology, the lofty expectations for AI-driven profits may be built on shaky ground. Investors could be setting themselves up for disappointment if reality fails to match the hype. The market's expectations may be way ahead of reality. As Burry's warning echoes through Wall Street, the question remains: will investors heed his advice this time, or will history repeat itself? The stakes are higher than ever, and the outcome could reshape the future of technology and the global economy. To understand today, look back to the late 90s dot-com bubble. Investors went wild for anything .com, ignoring fundamentals and driving prices to absurd heights. Valuations soared, companies with no profits traded at astronomical prices, fueled by hype and media frenzy. The Nasdaq doubled in a year, with PE ratios over 120, pure mania. Then the bubble burst. The Nasdaq crashed 80%, and fortunes evaporated. The lesson: fundamentals always matter. That ghost haunts the AI market today. Fast forward to today, AI is echoing the dot-com era. Investment in AI has exploded, with valuations stretched and the Nasdaq's PE ratio far above average. Stocks are priced for perfection, one misstep, and prices tumble. The market is dominated by the Magnificent Seven, making up over a third of the S&P 500. This concentration is riskier than ever. If one giant stumbles, the whole market feels it. Diversification is shrinking as everyone piles into the same few names. It's a crowded trade. We soar, brober. And when the music stops, the fallout could be swift. The stakes are higher than ever. The similarities are scary, but there's a key difference: interest rates. In 2000, the Fed raised rates, popping the dot-com bubble. Today the Fed is cutting rates, making money cheaper and fueling the AI boom. Cheap money lets tech giants fund massive projects and VCs back more startups. Bulls argue that as long as the Fed keeps pumping liquidity, the party can last. This easy money environment can sustain high valuations longer than expected. The bubble may still pop, but the trigger will be different this time. Understanding this is crucial for investors. If the Federal Reserve isn't the pin that pops the AI bubble, then what is? The world is watching as artificial intelligence continues to dominate headlines, drive stock prices, and fuel dreams of a tech-powered future. But as with every boom, there are always risks lurking beneath the surface. Potential triggers that could deflate the hype and bring valuations crashing down to reality. Several risks could burst the AI bubble, and it's important to understand them before getting swept up in the excitement. Investors, analysts, and everyday people are all asking, what could go wrong, and how quickly could things unravel? First, there's the risk of widespread job losses. AI is automating tasks at a pace we've never seen before. If companies lay off workers faster than new jobs are created, millions could find themselves out of work. This would mean less money in people's pockets, leading to a drop in consumer spending, the lifeblood of the economy. If spending falls sharply, a recession could follow, putting even more pressure on businesses and markets. Second, there's the danger of extreme investor expectations. Right now, AI stocks are priced for perfection, as if every company will deliver blockbuster results. But the reality is, many firms are still figuring out how to turn AI investments into real profits. If revenues don't catch up to the sky-high valuations, disappointment could set in fast, triggering a wave of selling. A recent MIT study found a huge gap between what companies are spending on AI and the profits they're actually making. Billions are being poured into research, development, and infrastructure, but the financial returns so far have been underwhelming. This disconnect can't last forever. Eventually, investors will demand results. Third, there's the risk of value exhaustion. Even the most optimistic investors have their limits. When prices climb too high, people start to question whether the future growth justifies today's valuations. At some point, buyers may simply refuse to pay more, causing demand to dry up and prices to stagnate or fall. Overbuilding is another classic risk. In the rush to capitalize on AI, companies may invest heavily in infrastructure, buying servers, building data centers, and hiring talent, only to find that demand doesn't materialize as expected. This happened during the dot-com era when firms were left with expensive assets and little to show for it. If history repeats, the AI sector could face a similar reckoning. When profits disappoint, money dries up, and stocks fall back to earth. The AI bubble, like all bubbles before it, is vulnerable to a sudden shift in sentiment. If enough investors lose faith, the rush to the exits could be swift and painful, leaving behind a trail of dashed hopes and hard lessons for the next generation of innovators. Bubbles burst when reality fails to meet sky-high expectations. AI stocks are priced for a flawless future, making the market fragile. Margin debt is at record highs. When prices fall, forced selling accelerates the drop. The IMF has warned about the risks: concentrated bets, extreme valuations, and massive leverage. A crash could trigger global consequences, not just US losses. $20 trillion in household wealth could vanish. This affects everyone, not just Wall Street. What happens in the market ripples through the real world. Understanding these risks is vital to protecting your financial future. Crashes are scary, but they're also opportunities. When bubbles burst, weak companies disappear, but strong ones get unfairly punished. Think Amazon after the dot-com crash, down 90%, but it survived and thrived. The next crash will separate pretenders from contenders. The best companies, those with real products and profits, will be on sale. Smart investors make a shopping list and buy quality during the panic. Don't fear a crash. Prepare for it. History shows the patient, prepared investor wins big after the storm. So, what should you do when the market feels like a roller coaster and everyone around you is either panicking or chasing the latest hot trend? The answer is simple: don't panic, and don't get swept up in the hype. Emotional decisions are the enemy of smart investing. Instead of letting fear or excitement dictate your moves, take a deep breath and remember that the best investors keep their cool, even when headlines scream otherwise. Be an investor, not a speculator. That means looking for real, tangible value in the companies you choose. Not just a flashy story or a trending stock. Dig into the fundamentals. What does the company actually do? How does it make money? Is it built to last, or is it just riding a wave of excitement? The difference between investing and speculating is all about substance over sizzle. And here's a golden rule: diversify. Don't put all your eggs in the tech basket, or any single sector for that matter. Spreading your investments across different industries and asset classes helps protect you from the unexpected. If one area stumbles, others can help balance things out. Diversification is your safety net in a world full of surprises. Make sure your portfolio includes a healthy mix of sectors. Think steady dividend payers, reliable industrials, and even some growth opportunities. Dividend stocks can provide a cushion during tough times, while industrials often offer stability and long-term growth. Don't overlook the power of balance. Focus on quality above all else. Look for companies with strong profits, consistent growth, a real competitive advantage, and rock-solid balance sheets. These are the businesses that weather storms and come out stronger on the other side. Quality is what separates the winners from the rest. Remember, winners tend to keep winning, but only if you know how to spot them. Learn to recognize what a true winner looks like on paper: rising earnings, strong leadership, and a track record of delivering for shareholders. Don't just chase yesterday's success. Look for the qualities that drive tomorrow's growth. Keep learning, stay disciplined, and always be ready for opportunity. The market rewards those who put in the work. Stay patient, and never stop improving their knowledge. Read, study, and surround yourself with smart information. The more you know, the better your decisions will be. The AI revolution is real, and it's changing the game for investors everywhere. But remember, the path to success is rocky and full of twists. Do your homework, question the hype, and make sure you understand what you're investing in. If you stay smart, stay curious, and keep your eyes open, you'll be ready to seize the opportunities ahead. Booyah!